China's benchmark lending rates have been lowered. It's the latest move to consolidate the recovery momentum and boost support for the real economy. The one-year loan prime rate, or LPR, dipped lower by a less than expected 5 basis points to 3.65%. Meanwhile, the over 5-year loan prime rate decreased by a more than expected 15 basis points to 4.3%. Now, the one-year LPR is the reference point for most new and outstanding loans, and mortgages are priced off the over 5-year LPR. Lower loan prime rates mean a lower cost of financing in the real economy. Now, that's expected to bolster consumption, improve credit demand, and brighten expectations. China is able to lower its key lending rate in a rate hike environment by other major economies because the country has inflation under control. Okay, now with the econ class out of the way, let's look at the bigger picture regarding the Chinese economy. You might have read reports that China's economy slowed in July. The country is dealing with short-term headwinds, but its positive long-term fundamentals have not changed. Companies around the world are still voting with their feet to invest in the China market because they see the demand potential here. The latest numbers show foreign direct investment in China from January to July jumped 21.5% year-on-year in dollar terms. Now, during this period, investment from South Korea, the United States, Japan, and Germany rose by 44.5%, 36.3%, 26.9%, and 23.5% respectively. MNCs won't invest if they don't see new areas of growth potential in a market. According to McKinsey, the Chinese consumer market is already the world's largest in purchasing power parity terms, and the Chinese middle class will continue to grow in scale and purchasing power. In its latest quarterly earnings call, Walmart said its e-commerce sales in China surged 77% in its second quarter and more than 150% on a 2-year basis. The scarcest resource in the world is a supersized market. China has seen this. The latest economic readings for July need to be put in a broader context. Doing so shows the Chinese economy sustaining its recovery momentum in the first 7 months. When we look at production, supply, the labor market, and prices in this period, these all remained generally stable. Investment in the health sector surged 33% in the first 7 months annually, and investment in high-tech industries jumped over 20% during that period. In July, foreign trade swelled 16.6%, and the Business Activity Expectation Index for services was in the high expansionary territory of 58.8%. These are just a smattering of the economic gauges that show the growth potential of China's real economy. But in my opinion, a true test of governance, policy effectiveness, and the resiliency of a country's economy are what happens to the livelihoods of ordinary people when the global and domestic economy faces headwinds. In that category, China passes with flying colors. Despite all the turmoil we see in the global economy today, the Chinese family has seen their livelihoods strongly and effectively safeguarded, as there are no wild fluctuations in the prices or supplies of everyday goods, food, and energy. So, lowering the loan prime rate is simply the latest move in a series of policy measures to strengthen China's recovery and bolster the real economy. It's a move that will be welcomed by businesses and consumers alike.